Okay, I want you to picture this for a second. It's really terrifying when you think about it. Imagine a family, maybe, someone maybe your own relatives. They've saved up painstakingly $50,000 cash.
Wow.
Because they just don't trust banks. They don't trust the system. So they hide it somewhere, deep in a safe maybe, or under a floorboard. They feel like, okay, this is safe. We control this.
They think it's the only safe place.
Exactly. And then disaster. One night could be a fire. House burns down. Or thieves, sophisticated ones who know certain homes might have cash. And that $50,000, their life savings, just gone. Vanished.
It's a shocking scenario, and it's not just like a one-off story. It points to this huge kind of hidden issue in personal finance right now. So what we're doing today is a deep dive. We're investigating why, with digital banking and everything, are people still hoarding large amounts of cash at home? And our mission here really is to get past just judging it. We want to look at the psychology, the very real risks, and honestly, the surprising ways your money is actually protected, ways people often miss.
Yeah, our goal is to give you, our listeners, the insights to make, a smarter choice, a safer choice. And definitely stick with us because later on, we're going to blow up the biggest myth about keeping money safe in U.S. banks.
Oh, yeah, that $250,000 thing.
Everyone knows that number, right?
Right.
But we'll show you a totally legal, actually pretty simple way to ensure over $1 million, even if it's all sitting in the very same bank.
It really just comes down to understanding the ownership rules. It's simpler than you think.
Okay, let's unpack this then. Why is cash still so appealing? It's easy to just say, oh, they don't understand finance. But like you said, it's deeper, it's emotional, it's historical.
Well, yeah. And if you look just at current trends, you see this pull of physical cash. Even with younger people, have you seen that whole cash stuffing thing online? TikTok, YouTube.
Oh, totally. With the envelopes and everything. It looks kind of satisfying, actually.
It is satisfying for them. That's the point. It's visual. You physically sort the bills, rent here, food here, fun money there.
Almost like ASMR,
Exactly. That physical act gives this really strong sense of control, especially over impulse buys. You see the fun money envelope getting empty. That psychological boost is real. People feel connected to it.
But there are huge risks tied to that feeling, which we need to get into.
Massive risks, yeah.
And this is where it gets really interesting, I think. For so many people, especially first-generation Americans, maybe families with roots in Asia or Latin America, keeping cash isn't some trendy budgeting hack. It's like survival instinct.
That's the crucial difference. You hear stories, maybe like that Vietnamese family people talk about, keeping $50 K at home.
Right.
Well, because where they came from, banks weren't stable.
Right. Hyperinflation could wipe you out overnight.
Or the government could just decide to seize assets. So for them or their parents, cash you can actually touch. That feels like the only real security. It's not ignorance, it's learned experience, financial trauma, basically.
Yeah, they see a number on a screen and think that could disappear, but the bills in their hand feel solid.
And that creates this real tension, right? For the kids, maybe millennials or Gen Xers who are sort of the bridge generation.
Trying to explain HYSAs and stuff.
Exactly. Trying to gently explain that the U.S. system is different, that there are protections, without dismissing those very real, very painful past experiences their parents had. It causes a lot of family stress.
Definitely. And we also can't ignore the underbanked situation right here in the U.S.
Absolutely. Millions of households. For some low-income folks, cash is just easier. Maybe they lack the right ID for an account, or they're trying to avoid high bank fees that feel, frankly, predatory.
So it's a mix. It's structural, it's historical, it's behavioral, it's complicated.
It really is.
Okay, so understanding that emotional side is key, but then we have to face the cold, hard facts about the risks, keeping that much cash at home. You called it the triple threat.
Yeah, threat number one. It's the inflation thief. This is just basic financial erosion. That $50,000 hidden away, it's not safe. It's actually shrinking every single day.
Silently.
Silently. Think about even moderate inflation, say 3% a year. That $50,000 loses $1,500 in buying power in 1 year. Gone. Invisible loss.
Well, if you just put it in, say, a high-yield savings account, depending on the rates, obviously, you could be earning maybe 4%, 5%, maybe more.
Easily. So you're not just missing out on potential growth, you are actively losing purchasing power. The money's just frozen, dead money. Over 5 years, that's thousands of dollars just vanished into thin air.
Okay, so that's the financial hit. What's threat number two?
Threat number two is the physical security trap. We started with the fire, the theft. Those things happen. Organized thieves do target homes or communities sometimes thought to keep cash. But here's the real kicker. The part people just don't grasp until it's way too late. Insurance.
But wait, don't most people have homeowners or renters insurance? Wouldn't that cover it?
You'd think so, right?
Yeah.
But no, not for cash. This is critical. Your standard policy has what's called a sublimit for cash, and it's tiny.
How tiny are we talking?
We're talking maybe a few $100s, sometimes $500, maybe $1,000 or $1,500 if you're lucky. Tops.
Seriously. So if your $50,000 in cash disappears in a fire or theft,
you might get, say, $500 back from insurance. You've basically self-insured the other $49,500. You've taken on almost all the risk yourself. You traded perceived safety for, like, guaranteed vulnerability if something goes wrong.
wow, that's a huge reality check. Okay, so let's say you dodge the thieves, you avoid the fire, you have this cash pile for years, and finally you think, okay, maybe the bank is better. You decide to deposit it. Still a problem, right?
Still potentially a huge problem. That leads us to threat number 3, the legal trap. Specifically, something called structuring.
Structuring. Okay, what's that?
People think, okay, I have this, say, $50,000 cash. I don't want the bank flagging it, asking questions, telling the government. So they think, I'll be clever. I'll deposit $9,000 this week, $9,000 next week.
Trying to stay under that $10,000 reporting threshold? Makes sense why they'd think that works.
It seems logical, but it's illegal. That act of making multiple deposits, specifically to avoid the currency transaction report, CTR, that $10,000 trigger that is structuring.
And that's a crime, even if the money was earned completely legally.
Yes, that's the dangerous part. The crime isn't necessarily where the money came from. The crime is the act of intentionally structuring the deposits to hide them from reporting requirements. It can lead to serious legal trouble, big fines, even the government seizing the money.
So the very fear that drove them to hoard cash in the first place, fear of scrutiny, leads them right into potential legal disaster when they try to fix it?
Exactly. It's this terrible cycle. Fear leads to hoarding. Hoarding leads to inflation loss and theft risk. And trying to deposit it carefully leads to legal risk.
Okay. This makes it clear we absolutely need to shift away from fear towards understanding how safety actually works in the U.S. financial system. Let's talk solutions. Let's talk trust.
Right. And when people talk about bank fears, they often mention, the Great Depression or maybe more recently some regional bank wobbles we saw. Valid concerns, historically.
Yeah.
But the game changer, the bedrock here is the FDIC, the Federal Deposit Insurance Corporation.
So explain that. Why is the FDIC different? Why should someone, especially maybe someone whose parents had terrible experiences with banks elsewhere, trust this?
Because the FDIC isn't just the bank promising things. It's an independent agency of the U.S. government. It's backed by the full faith and credit of the United States government itself.
Okay.
And the track record is just flawless on this point. Since it was created way back in 1933, after the Depression, no depositor has ever lost a single penny of their FDIC-insured funds. Yeah. Not 1 cent, ever. If your FDIC-insured bank fails, the government guarantees you will get your insured money back, period. It's one of the strongest financial safety nets in the world.
That's a powerful guarantee. But still, that number everyone knows is $250,000.
Right.
And for some families, maybe they sold a house, maybe they have a successful small business cash flow. $250,000 might not cover everything they have. So they still hesitate to put, say, $400,000 or $500,000 in one place.
And this is where we bust that myth wide open, that $250,000 limit. It's not per household, it's not per family, it's per person, per bank, per ownership category.
Okay, ownership category, that sounds like the key part.
That is the key. It's how you title the accounts. It unlocks much higher levels of insurance.
So walk us through that family example again, a married couple. How do they easily get way past $250K insured, maybe hit that $1 million mark, without needing like 4 different banks?
It's surprisingly straightforward once you see the category. So our couple, they go to one bank, they open 3 basic accounts. Okay. Account number 1, an individual account just in the husband's name. That's insured up to $250,000.
Got it. One person, one account.
Account number 2, an individual account just in the wife's name. Also insured up to $250,000.
Makes sense. 2 people, 2 accounts, $500K coverage so far.
Exactly. Now, account number 3, a joint account owned by both of them. Because there are 2 owners on this account, it's insured for $250,000 per owner.
So the joint account gets $500,000 coverage, $250K by 2 owners.
Precisely. So add it up. $250K husband plus $250K wife plus $500 account joint, $1 million. All insured by the FDIC at the same bank.
Wow. Okay, that simple structure, just using individual and joint accounts, quadruples the basic insurance level people think they have.
Right, and it can go higher. If they have, say, revocable trust accounts set up for kids, those can represent different ownership categories, adding even more potential coverage. The point is, the system is built to protect significant sums, far more than fits under a mattress.
So, knowing all this, the risks of cash, the actual safety of insured deposits, what's the practical advice? How do you balance maybe still wanting some cash for emergencies with the need to be smart financially?
Yeah, the consensus among financial experts is pretty clear on this.
Yeah.
Keep a small amount of cash at home for, like, genuine immediate emergencies.
How much is small?
Think maybe $500 to $1,000, enough to buy groceries if the power's out for a day or if ATMs are down after a storm. Truly short-term needs.
Okay, so $1,000 maybe?
Maybe. Anything more than that. It really belongs in a protected place where it's safe and ideally earning some interest, not losing value.
I like that idea you mentioned, the hybrid approach, for people who really like that physical control, that cash envelope system.
Yeah, the hybrid model can be a great compromise. Keep using the physical cash envelopes for your, like, flexible spending, your wants.
Like eating out, entertainment.
Exactly. Things where having that physical limit helps control spending. You get that psychological benefit, that feeling of control.
Yeah.
But you automate the important stuff. Bills get paid automatically from your checking. And your serious savings, your emergency fund, beyond that $1,000 cash, that goes straight into a high-yield savings account or maybe CDs. Protected, insured, and growing.
So you get the best of both worlds, sort of. Control where it helps you, safety and growth where you need it.
Precisely. You manage the emotional need without taking on catastrophic financial or legal risk.
Okay, we have covered a ton of ground here. From the psychology of cash hoarding, like with that Vietnamese family example maybe, rooted in history.
To the triple threat of inflation, lack of insurance, and legal traps like structuring.
All the way to understanding how FDIC insurance actually works and how you can insure, $1 million or more at one bank.
The big takeaway really is that being financially cautious is good, right?
Yeah.
But it needs to be balanced with being financially smart, financially efficient. We should absolutely honor family history, understand those past traumas, but we can't let those past fears dictate actions that actively hurt our financial future today through very real risks like inflation and lack of security.
So maybe the final thought for everyone listening is this. Take an honest look at any cash you might have stashed away. Why is it there? Is it truly for immediate practical needs? Or is it maybe more about an emotional comfort blanket that's actually putting you at risk? Context is everything, isn't it?
It really is. Asking that why is the crucial step.
And hey, if this deep dive got you thinking about your own habits or maybe helped you understand why your parents or grandparents feel the way they do about banks and cash, we'd love to hear about it. Do you keep cash on hand? What feels like a reasonable amount? Let us know anonymously if you prefer down in the comments. It really does help everyone learn.
Yeah, share those experiences.
And of course, if you found this useful, give us a like, subscribe for more deep dives like this one, and maybe share this episode. Could be a friend, could be a family member who really needs to hear about that FDIC $1 million potential more than you do.